Good afternoon to everybody and welcome to the fourth webinar organized by the International Business and Tax Center at the European University. As you know, the International Business Tax Center, the IBTC, was created quite recently. And what we would like to propose in our webinar is to put together at least the two sides of the tax law. We want always to start from a case study proposed by the multinationals and then addressed also by professionals, and then to discuss the pragmatic approach also with some academics, some professors from different universities across the globe. The topic of today is the principal model and the profit split method. The purpose is to address whether, and if so, how the profit split method applies to the principal structures. We want to actually explore together if it's the case to reconsider the principal model and to reconsider the degree of centralization, looking, of course, at the contribution that each company provides and carries out along the value chain. So, of course, we want to do that based on the OECD Transfer Price Guidelines 2017 after BEPS, and based on the revised guidance of the application of the profit split method in 2018. So we want to discuss this, and we want to start, as I said, from a case study proposed in this case from the Unilever company. And that's why I go straight to give the floor to the first speakers of this webinar. And we have Paolo Ricca, Head of Tax from Unilever Italy, and Daniele Ciolfi as a Global Transfer Price Manager from Unilever Netherlands. They will be discussing the multinational enterprise business, risks and functions, profit split, and the guaranteed remuneration. Please, the floor is yours.
Thank you very much, Gianni. So let me start. So thank you very much for inviting us to propose this topic that we want really to bring to your attention. I believe it's quite a critical topic for most of the multinational enterprises. Indeed, you know, it's the typical dilemma that we have when we have an international business. So Daniele, if you can move the slide, let's go straightly to the point. In the agenda, we will treat, this sort of conflict between integration and independency, which are, the two factors which really drive the decisions of the multinational enterprises. Then we will transfer the topic to the transfer pricing perspective, because, every business model has is mirrored by a TP methodology, and the great challenge is to decide what is the best way to represent in terms of taxation and transfer pricing the business model. We will present you a business case, and we will conclude with some open items that we believe are really food for thought for all of us. So let's go straight to the point. We said multinational enterprises, so we are talking about business which are by definition international, so companies which cover many countries, which by definition, they can provide service, they can provide goods. This is not very relevant. What is relevant is that they have a sort of, a common and single product portfolio. And of course, they need to be absolutely in line with the requirements of the consumer and customers in the different countries. So from one side, there is the need for the company to exploit the synergies, to standardize as much as possible, to centralize the functions, because in the end, there are economies of scales. And this brings a lot of benefit in terms of costs, in terms of efficiency, as I said. On the other side, there is the need to meet the consumer demand. Of course, my split is a bit biased by the fact that, as Unilever, we operate in the business of the fast-moving consumer goods. And then by definition, in this business, there are similarities. It's in essence, a consumer from Italy is no different from a consumer in Vietnam. But it's clear that a multinational enterprise needs to seize the opportunities which are offered by the markets. There are also local competitors. So there is this continuous conflict between being global and being local. Now, the people say, experts say, you should be local, which means nothing or means everything, but it's definitely the great challenge that entities need to manage nowadays in the global competition. Now, in order to introduce our case study, let me try to simplify a bit the way business operate when it's about, international businesses. So let's assume a very standard structure where there are key elements which can really be modified depending on the objective of the multinational company. So let's say that we have the principal, which is the entity which gives the strategic direction, which takes the decisions and needs to decide if the decision should be taken locally or centrally. We have the management of the IP, or the intellectual property, which is normally the great asset of these multinational entities, multinational companies. This includes the brands, this includes the technology, the know-how, all the intangible elements that are easily, I would say, centralized, because normally there are synergies, very strong synergies in keeping it centrally and dedicating resources for the development, the technological development, also just the brand and the communication development. And then inevitably we have a local sales organization. So we have entities in the territories because it's necessary to have the contact with the market. It's impossible not to operate in a market without a market and sales organization. And we will see if it's easier to be there with an autonomous organization, or we need to be more centralized in the splitting of the functions. Now we are assuming that we have also factories. So we are assuming a business where we have products, goods, so tangible goods and more than services. But this does not really change the conclusions. And finally, we need also to consider that the business like this is normally organized with the ancillary activities which are relevant in the supply chain. We don't bring a low value, added value to the value chain, but are definitely very important in the overall value chain. So let's say that if these are the elements, we can identify two extremes, two different ways to manage the business. So one is the most centralized business model, where we have the principal, which decide to keep for himself all the key decisions, all the strategy, and leave just the execution to the territories. We are assuming that it's not really an issue to centralize the activity for the supply chain, for the production, like for the ancillaries activities, because maybe the region, the geography is Europe. So basically it's very, very easy to move goods from one country to another. But we really believe that in the markets, we don't need to be so to offer a customized offer to the consumers, so that we have the principle and we have a highly centralized business model. On the other side, we have the model where we give more autonomy to the territory. So assuming that sourcing units, so supply chain and ancillary activities are centralized, we decide to give a bit more autonomy to the local businesses, because we believe that there is a lot of value in doing that. Our assumption for our case study is that the IP can be centrally managed and that there is no substantial benefit in keeping this locally. So these are, the two extremes from the business perspectives. Of course, the reality is not really black or white. But I think that to keep a bit polarized the conversation may help to understand what are the challenges when we move from the business organization to the transfer pricing methodology. Daniele, over to you to go deeper in the analysis of the methodology aspects for transfer pricing.
Yes, thanks, Paolo. I'd like to start from this point that Paolo explained to us. So there is a different way to run the business, centralized or giving more autonomies to the local, in this case, MSO, so marketing and sales organization. What is nice to understand is that if we focus our attention of this kind of business, so the co-principal business, with the supply chain principle in our example and the local MSO, for sure we are assuming that there is an high integration of function of risk of these two kind of business, because having two entrepreneurs on the market means that the function and the risk are really shared. And if we look at the OECD pricing guidelines, we recognize in this organization exactly what we find in the OECD guidelines, where when we have to integrated the business, really integrated itself. So in our example and in our business case that we will present, a supply chain principle, for example, and a local entrepreneur as a marketing and sales organization, the profit split is the most appropriate way to split the profit across the two entrepreneurs. So that's our starting point for our business case. So we are assuming two really integrated business that deliver business in a different way. One is the principle of all supply chain activities, and the other one is let me say, the principle of all marketing activities. And we deliver, and we have in this situation, a really business that need to be considered as something like a unique business. In this unique business, you have the possibility you need to consider a profit split as the best way to split the profit between the two entities. But how we need to study and how we need to arrive to determine the profit to be split between the two actors in the market. First of all, you need to consider the process and the value driver that the process have embedded in. So if we consider which is the value chain of the entire business, we really need to focus our attention of the single process that we have in our business to understand which is the value that bring to get in the total profit for this kind of business. So first activities that we need to follow up is understand the little pieces of the contribution that the single function is in the and put in the total business. In the other part of the analysis, we need to consider the responsibilities of these kind of processes. So we need to split the process and understand who is responsible in terms of WOLC, so who is accountable, who lead, who make the work, and so on, about this kind of process. Having this split, we understand the contribution of each responsibilities of each actor in each product, in each process. And this exercise is fundamental to arrive to determine what we call the PCA, process contribution analysis. So the process contribution analysis is the overview of the process and responsibilities performed in two more integrated business. Having determined it, we only at this moment we can consider how we can split the profit between two or more legal entities involved in the same business. And if we want to have an example before presenting our business case, you can see on you have in front of you an example of a table where the principle in this case could be considered, for example, a principle that lead all the operation related to the supply chain, and the MSO is the marketing distributor, also an entrepreneur in countries. And you see that we really need to understand which is the major processes that we are analyzing. So we need to split all the process. We need to, through interview or through more, let me say, real factor, understand who is responsible between the two actors of each processes. Having said that, we need to weight the process and we need to weight the contribution analysis and we need to summarize everything in a profit allocation. So when you have this kind of exercise, you are mirroring the process that the OECD advised to do to understand which is the profit, the arm's length profit allocation. And in our example, we will show this kind of contribution analysis that land to a profit split 70-30 between the principal and the local entrepreneur that make all the marketing and sales activities. So what we are now presenting in terms of number, in terms of business case, is a differences between which is the remuneration under an LRD distributor. I mean, let me say is that in case a process contribution analysis is not valid because it's clear that 99% of function is done by the principal and only an execution rule is in the end of the local MSO, it means that we land probably in a TNMM. So it's not in a profit split, but a different method to calculate the remuneration that is more simple to benchmark with the real market. So what we are saying now is, if we arrive to conclude that we are in presence of a really integrated business that need to be treated with a profit split, we want to compare this kind of profit allocation with a limited risk distribution profit allocation that is more or less a TNMM, no? Or a return of sale, as you prefer, just to understand which is the effect of some combination of factors to understand which is the economic and the financial consequence on the profit and loss of the two legal entities. Before to go in the number, we need to consider that when we speak about profit split, we are combining two profit and loss. So to have the possibility to compare apple with apple, we need to take in consideration some other important step to do before. First of all, when we are in presence of different legal entity in different countries, probably we have the problems to compare a different gap in terms of profit and loss and in terms of financial statement. So first activities, first issue that we need to face is the gap selection. So before splitting something, we need to have the full visibility and the full profit and loss made with the same gap. So that's the first exercise to avoid to compare apple with pears. The second exercise is select another starting point, that is the currency. This exercise is exercise that are also embedded in the TP guidelines of the OCSE. And so select same gap, same currency. Other selection that we need to do before splitting something is understanding which level we need to split the profit. We need to consider the operating profit. We need to consider also the overheads. We need to consider financial cost or revenues or not. So we need to select the right profit indicator. And finally, we need to decide if we want to split the profit according with the actual amount or budget amount. It depends if our profit split is done need to be done with a budget amount, so predetermine the figures that we need to split, or it is a profit split that takes in consideration the real number of the business, so the actual amount. And probably in this second scenario, you will have a true up at the year end to split also the timing difference that you can have in different profit split. So having said that, we can go with a really simple example, and we want to take this as is to permit to the audience to have a clear vision of what we are doing with this example. In the first part on the left, you have a really simple exercise when the remuneration on LRD is based on the turnover. So it's a fixed percentage of the turnover. And the principal have all the residual profit split, all the residual profit in its profit and loss. You see that in case of LRD, you only need to multiply the side percentage that it could be according with an external benchmark for sure, to avoid any challenging of and to stick to the TP guidelines. You can have also different percentage, no? Because probably in some multinational you can have different brand or different product finished goods with more flexibilities in the end of the LRD. So we make a proposal in this example, and we can say is that you can have global brand. I don't know if somebody from a big multinational is here as, for example, I take in consideration one that come in my mind is Coca-Cola. For sure, Coca-Cola is the same brand and same product in Japan, in China, in US. So probably you are in a situation where you have a global brand, all the activities are performed centrally, and the local MSO are really have a really executional role. So in this case, the percentage could be lower, but you can have also, let me say, local brands. So in the differences that Paolo explained before, when there is a big trend and a big duality between global and local business. In this case, in case of local business, you can have some other kind of product that could be remunerated more, because the local MSO can done more function. It is a simple example. So you have a turnover, you multiply the return on sale percentage on the turnover, you have the remuneration of the LRD. The rest of the remuneration, so the residual profit, is always in the end of the principal. What happened in case of profit split? In the profit split, you need to put together the profit and loss of the local entrepreneur in country A and principal in country B. You need to eliminate the intercompany amount, because it is relevant only the turnover and all the cost and income that you produce with third parties. In this situation, you arrive to a gross profit. You have other kind of cost that, for example, OPEX, that bring your profit and loss to operating profit. And in this case, you apply the TP adjustment considering the profit split percentage. In this case, you split, in our example, 70% for local entrepreneur, 13% for the principal. So you put together, as we said, the amount of the taxable base in this situation, and you split 70-30. So what happened in case we introduce some external condition? In this slide, we only modify what happened in case of decrease of turnover. We can imagine our mind goes directly to COVID, pandemic, and so on. But in case of decrease of turnover, you see that the LRD do not take in consideration this risk, because all the risks are in the end of the principle. So in case of pandemic problems, as we had, but in any case, when we assist to a decrease of turnover, for sure, the impact is 100% in the end of the principle. What happened in a situation where we have two entrepreneurs and we split the profit? For sure, we also split the risk. So in case of total, I say the taxable base, but just to understand that we are speaking about the last level of profit and loss. We have a loss due to the problem of decrease of turnover with a little decrease of the cost associated, because you have fixed costs that it cannot impact to the decrease of turnover. You split also the loss. So profit split not only means split of profit, but means split the total amount of profit and loss. And also in case of losses, you are splitting the loss. Why we put this on the table? Because for sure, in this year, we have a lot of these cases. And we really need to have an important discussion with tax authorities next year in case of audit, because all the countries where profit split, all the entities where profit split is the base where we need to that we use for split the profit of two integrated companies, will have this kind of problem in front of authorities. It is the reality, I mean. So we really need to demonstrate what happened to the decrease of the business, the decrease of turnover, and we really have good argument to say that profit split is not something that could guarantee profit to one legal entity or another, but profit split means also, in case of loss, a loss split. I mean. Another case that we like to discuss is in this third example, we had a new cost, I mean, that is really common in our financial statement, the intercompany royalties. Many times, as we see also with Paolo, we have a dedicated legal entity where we put all our IP, our technology, our brand, and this kind of legal entity is in the 99% of the case remunerated with a royalty rate. So in a situation as we are facing now of crisis or pandemic situation and so on, we really need to we really receive challenging, and we will receive challenging from authorities. Why in this situation of uncertainty you continues to remunerate with fixed amount any EP owner, and the profit split entities continues to receive the not only profit, but also we see before a loss to split. In this case, you see that in case of LRD, introducing a cost of royalties do not impact the LRD remuneration because they continue to be paid on turnover. But what happened in case of profit split? Royalties is a cost that has the other need to be split. So in this situation, what happened? We are we are shifting profit, guarantee profit, because turnover are royalties 99% is calculated on turnover. So we are saying that the EP owner continues to have a profit that is certain, but what remain in the countries that apply the profit split is only a loss. Also, if in case of turnover remains stable, we see that in this situation we have a decrease of turnover. But this is just is a school example, but just to understand that also in case that we do not assist at the crisis or something like that, it's possible that intercompany royalties decrease the profit to be split in the profit and loss of entrepreneur or local entrepreneurial principle. So it is something that we'd like to share with you some impression on how to manage this kind of situation. Because in many times somebody could say, okay, we can include the EP owner in the profit split just to have the standard, the splitting in 3 entities. But I mean, an owner of IP is something that could be considered a routinary transaction. So happy to discuss about this topic to understand how we can manage this kind of situation. So this is the 3 main example, or some example that we'd like to discuss with you, but I leave the stage to Paolo that will recap the open points and give us also other point of attention for further discussion. Thanks.
Okay, no, thank you very much, Daniele, for illustrating our case study. You definitely touch a lot of points. So basically, this point about the IP and the correct remuneration of IP in similar cases, I mean, I believe it's very critical. But I mean, there are many open points. There are many questions which remain, I would say, open. We selected 3 because I believe these are really food for thought, and probably we should spend a bit of time to really understand what could be the answer and the solution to this fundamental question, I would say. The first one is about the contribution analysis, because Daniele illustrated very well how it is necessary to go through a functional risk analysis to understand how to allocate the profit, and is to go to a fixed remuneration model or to a profit splitting. The approach that we propose is a very quantitative one, I mean, based on a percentage, based on identification of the right weight for each function, but probably, I mean, could be more appropriate to go for maybe some qualitative analysis. So the real question is how to manage the balance between analysis, which is a bit more based on mathematics, which makes probably life easier, or something which takes into account some qualitative aspects which are probably prevailing in our modern businesses. The second point that I would like to bring to the attention is, as I said at the beginning, the reality is not black or white. And I mean, the international business tend to adopt mixed models or tend to change very, very often the models they adopt. So it could be that in one market they are more oriented to a profit split because they go through to giving more autonomy to the local entity. In other markets, maybe the solution for that specific geography is to be a bit more prescriptive and to manage the strategy from the center and limit the role of the entity on the territory. But I mean, this kind of approach can be also changing over time. So the business transformation is becoming the rule, and so the question is about how should we approach in these cases? Can we accept a mixed model? Is it not that a mixed model creates even more confusion and may trigger also questions from the authorities, because the authorities could really struggle to understand how it's possible that in one case in a market you are entrepreneur, in another market you are just a pure executor of strategies which are cascaded by someone else. And finally, I mean, the point of the exceptional circumstances. Now everyone talks about pandemic, talks about COVID, but I mean, exceptional circumstances may be any kind of radical change that can really affect the assumptions that drove the initial decision about going for a model to another. So if, I mean, at the beginning of our analysis, we conclude that we should go for a profit splitting, and then, I mean, there are also compensations which go back and forth between the entities. The question is, how should we approach in case there is some big restructuring, for example, or any big business event which changes the initial assumptions and really modify the balance of money between the entities. So we know that the retrospective, the hindsight is not ideal, should never apply, because you should apply the logic that was there when you decided, when you were taking the decisions. But in some cases could be really necessary, because in the end the circumstances have changed so much that it's impossible to ignore what has happened. So these are the three open items. I believe that we have given a lot of food for thought. I give you the floor to you, Gianni, to continue with the workshop and to see the contribution of our nice panelists. Thank you very much.
Thank you both of you, Daniele and Paolo. Thank you for this presentation. Definitely you provide a lot of interesting feedback for the further discussion about this topic. Let me just touch a few points before going to the next presentation, because yeah, maybe the local tax authority is starting to complain in some cases about the fixed stable remuneration left at the local level. So that's why we are here today to discuss about the application and how to apply, if it is possible to apply the profit split method in some cases. It was really interesting to see the comparison that you show up with your numbers, you know, the limited risk distributor on one side and the local entrepreneur on the other side. It's also interesting to see the concept of the two entrepreneurs at the central level and the local level. So we are here to investigate further into this topic and to see even if the mixed model can work. My personal view, the mixed model can make the global TP policy in some cases weaker than stronger. So it's something to investigate further, to go, of course, into the details about it is really feasible and applicable. But in any case, when we talk about the potential application of the profit split method, the key role is definitely also played by the risks allocation. You, of course, mentioned the risk allocation. You mentioned also the COVID-19 issues, but in that case, we can, in some cases, we can distinguish between the extraordinary risks, like the well-known now, unfortunately, hazard risk due more to some extraordinary event, and to the ordinary risks linked more to the value chain itself. So now we have to investigate further how the risk allocation can work with the application through the application of the profit split method. So that's why I'm really happy to give the floor to Isabella Berlinden for her presentation about navigating through shorter value chains and disruptive transformation, splitting risk more than splitting hairs. Please, Isabella, the floor is yours.
Thank you, Gianni. Thank you very much. And it's great to be here. And thank you for the invitation from the university. I would need to start with a sort of a disclaimer, because what I'm going to say is probably much more boring than what we heard from Paolo and Daniele. But indeed, I would like to talk about the risk control framework. So I don't know, Mr. Ria, whether it's possible to have the first slide on the screen. That would be great. The first one, yeah, fantastic. So thank you. That was a mouthful, the title, and I'm sorry for that, Gianni. But what I wanted to start with, and I think Paolo already mentioned it, like is it now localization, globalization, glocalization, all sorts of terms that may or may not be carrying that much sense, so to say. But what we do see is that the world is more connected than ever through technology means. And a good example, I thought, was to talk a bit about shorter value chains. What I mean by that is there was a time that people in supply chain management needed to have a phone. They needed to have a lot of spreadsheets. And now what you see is they need to have access to proprietary machine learning algorithms, and they're communicating in the cloud to make sure that the value chain is run as effective as possible. And then the question is indeed, where does the risk control framework ties in all that? So I thought selecting a bit of a fun slide for that. No risk, no fun. No fun, no transfer pricing, I would say. So that's what I would like to talk about a bit. And staying with this slide for 1 second, I would like to go back to the basics of what was introduced in the transfer pricing guidelines already more than 10 years ago with Chapter 9, the business restructuring chapter. And the reason for doing that, and I'm sorry, it's boring, but the reason for doing that is that there was for many years a sort of a frustration, because principal models that were popping up, let's say from the mid-90s, created a certain frustration with tax authorities, like, how am I getting the ammunition to see where the tax risk lies? And on the other hand, for taxpayers, it was also very frustrating, because whatever you did, either you had too much functionality and then you risk transfer pricing attacks, or you had not enough functionality and then you were risking permanent establishments attacks outside the country of the principal. This Chapter 9 made it very clear, very important, and that is, you can diversify entrepreneurial risk within a multinational, because by the same token, the OECD could have said you cannot do that. So you can do that provided you have the people with the capabilities and with the expertise and with the empowerment to credibly oversee entrepreneurial risk. And I will be talking about the difference between control over risk and mitigating risk, and how this all brings us into a sort of a situation where we had, after the introduction of Chapter 9, the BEPS project. So we're all familiar with actions 8, 9, and 10. And then after the introduction of the 2017 changes to the transfer pricing guidelines, we saw in 2018 additional risk on profit splits that were introduced, where, and now I come to the point I want to make in my 20 minutes here. The point I wanted to make is that it seems as if quite some tax authorities feel tempted to say, hey, I see DEMPI functions outside a certain jurisdiction, outside the principal jurisdiction. So I feel that by definition, I have to go for a profit split. Whereas I would like to make it very clear, we have Chapter 1 dealing with the actual delineation of the transaction. We have Chapter 2 dealing with the methods. And then we have chapter 6 dealing with intangibles. That was probably the root of the issue, the root of the issue, why it was important to introduce that DEMPI criterion. But I would like to come back to the fact that we should start with the actual delineation of the transaction, knowing, and I would like to refer to the caveat that Daniele was making by referring to paragraph 1.10 of the guidelines, that there is an inherent flaw, so to say, in the transfer pricing guidelines. But so there can be a certain economic solidarity between entities making part of a multinational, without this becoming without this becoming by definition a reason to say economic solidarity means a shared controlling over risk. So if we go to the next slide, please, Alessandro, thank you so much. Very, very quickly. So we see a number of disruptive areas where you see that the way in which multinationals are run are affecting also the way in which we need to look at control over risk. And so this is where, again, referring to this paragraph 1.10, we have to think about industrial organization economics. So a company adopts a certain market strategy. So you have a differentiation through the way in which you commercialize your products. And we heard it, I think, already extensively. Companies like Unilever, because of the pandemic, you all of a sudden had to accelerate the move from offline to online. And I think I even saw it in your extensively being dealt with in the annual report. But we see a number of other challenges that bring the transfer pricing practitioner to a couple of questions. And that's what I try to summarize in my next slide, if I may, Alessandro. Thank you. So working remotely, and I know it's going to be touched on by other speakers, but what does this mean? Does diversifying my brain power automatically means that I shouldn't look anymore at the contractual allocation of risk and immediately say, oh, the DEMPIs are sitting everywhere, so this is a default profit split? I don't think so, but it has definitely a number of other incidences where countries need to look at. And I was invited by the European Parliament Fisc Committee last week to share some insights on new practices the European Commission might want to look at. And one of the other speakers was Professor de la Feria, who was making a point. She tapped from a contribution she made together with my colleague Giorgia Maffini on the importance of personal income tax in absolute terms. So, and you heard through the dynamic of the interventions and the questions that we're all looking at corporate tax. There is a lot of focus when the European Commission deals with anti-tax avoidance directives and so on corporate tax. But then, at the end of the day, in quantitative terms, the impact of a mobile workforce in terms of personal income receipts for countries is much more important. So this working remotely, what does it mean? I'm going to talk about the DEMPI aspects of that in a second, in combination with managing supply chain risk and disruption. And you have a lot of emergency contingency plans that have been introduced, not only because of COVID-19, I heard that, but also I think a few months ago, nobody would have thought that we would be confronted with an ocean freight crisis. Nobody would have thought that a boat would block the Suez Canal. And so you see immediately companies having to try to get products from A to B. And what does this mean if I am going to slice and dice my streamlined supply chain organization in bits and pieces. The sheer fact that I have a number of distribution centers, emergency centers that I have been setting up in countries, does that mean that the management of that is also entrepreneurial enough to impose a default profit split? Don't think so, but that's what I have already been seeing in tax authorities' questions recently. The acceleration of all things digital, I think I already mentioned that when referring to the way in which value chains are managed through all sorts of algorithms and so on. And then the question is, what does this mean? Who is controlling the risk of the offering related to that? And are data then only the input, or is digital data, our data, customer data, already enough to say this is something I'm controlling, and by the sheer fact that I'm doing that, I have to be confronted with a profit split? And then accelerating M&A activity. Companies are looking for creating value add, and you either do it yourself or you do it with third parties. What does that mean in terms of comparability and so on? Does that put an additional strain? And what does it mean in terms of control over risk? Why do I mention that? Because as a matter of principle, you're not controlling a third party to whom you are outsourcing something. But again, when the OECD was crafting its solutions in the context of BEPS, there was a lot of discussion around what the control over risk meant. Also, when you're putting yourself in the shoes of a third party. So, if we would go to the next slide, please, Alessandro. What I would like to come to. So I'm going to be somewhat critical on the way in which the guidelines are drafted. This is in no way meant to be a criticism to the work of the OECD, because I think, as we all know, they're doing an amazing job with the brain power they only have. So they have limited resources, and there is an evolving sort of interpretation in the guidelines. So what I would rather like to say at the end of my presentation is that there are a couple of issues for which it would be good for the OECD to bring together a number of practitioners like ourselves and to share and to see where some of the issues can be, some of the paragraphs can be made more clear, and what further work can be done. Another possibility would be not only in the hands of the OECD, but for instance, the European Commission in its 25 action plan of last year in July. I think one of the points there was to restore something like the joint transfer pricing forum. So a group of people thinking about pragmatic solution to transfer pricing issues. And I think this risk control framework could be a very good one. Because my question here, and it's a provocative question, is isn't there a bit too much emphasis on risk? So the risk control framework, it's very clear why it was introduced, and again, in the context of BEPS, we understand highly capitalized empty shell companies to which you are allocating IP. We understand the premise was this is not going to fly. We understand that, but now when I look at how the risk control framework is drafted, we know that to be characterized as risk bearing, and that's my fourth bullet on the left, an enterprise must possess the ability to assume and control the risk associated with its activities, including the financial capacity. And the financial capacity means the capacity to have access to independent sourcing. So that sort of financial capacity is not simply saying I create financial capacity by the sheer fact that I'm creating economic ownership. I think it was very clear that the OECD abolished the notion of economic ownership. So my question is then, how do we marry the control over risk with the value creation? And we know that in the OECD guidelines, the risk management analysis comprises an examination of three things. So risk management is deemed to be there if, first of all, the first requirement is satisfied, that is, can I take the decisions to take the risk, to lay off, or to decline a risk-bearing opportunity? What about my decisions on whether and how to respond to the risks associated with the opportunity? So do I have the empowerment and the expertise to do that? The third bullet, the actual mitigation, I can leave to somebody else. So control over risk does not mean that I also have to do the risk mitigation. So the consideration here is that if I have sufficient decisions in categories 1 and 2, as I just mentioned, well, if I have enough of that, what about then the category 3? So in practice, in theory, this makes perfect sense that the risk mitigation doesn't need to be part of it. But in practice, it gets sometimes blurred with the first two. And it would be very good if we could, for instance, share a couple of examples in reality where companies feel the boundaries of disconnecting 1 and 2 from 3 respectively. So next slide, please. So is there then a sort of an emerging conflict between the arm's length principle and value creation? Because the risk control framework is a behavioral test. So the question is very much whether the control over the inherent risk is exercised. So when it's exercised as specified in the contract, and also in a way that we would expect third parties to do so, well, then we're gonna respect the actual delineation of the transaction. However, if there is no alignment, then there can be a redelineation of the transaction. So that's how the arm's length principle and the OECD transfer pricing guidelines work. Now, the concept of the value creation, if we bring that together with this, with what I just said about the OECD approach, we have to think about what it means if then the risk control decisions as such are also valuable. So value creation carries the suggestion that the risk control decisions are not only relevant when testing the assignment of risk and the assumption of the risk in relationship to the functions, but also that they are themselves inherently valuable, and that the people who are dealing with them, who are executing them, are in fact creating an entitlement to residual profit. So then we're straight into that sort of confusion around the DEMPI concept. And this is what I meant at the beginning, where I feel that the 2018 updates of the work on profit split seems to give some push, or at least some comfort for tax authorities who would go that route, whereas I can't believe that this was the intention of the guidelines. So to conclude, I have then 3 questions on my next slide that I think would be worthwhile taking further for further consideration. And that is, first of all, how to determine when the profit split method can be applied. So, and this again is something where the control over risk, how boring it may be, may need some further discussion, may need some further exchanges of views, because there is not a lot of explanation in the guidelines. So for instance, is a profit split method the best method if there is a shared assumption of economically significant risks? Or is it enough to have separate assumption of closely related risks? So that is the first question. Then secondly, the question I already raised during my presentation, when I am looking at a risk management activity, I do understand the 3 bullets. So the decision to to take on the risk or not to take on the risk versus the mitigation. Is it clear enough what the distinction is between the two? Where does the borderline lie? And then thirdly, under the actual performance of risk, it's very important to see, and I think my slides are gone, but that's not a problem, how to differentiate between the kind of risks. So there can be high consequence versus low consequence decisions, and the guidelines don't make a distinction. So it would be helpful, for instance, when dealing with profit split, when profit split would be the most appropriate method, that this would at least as a minimum apply to this sort of high consequence sort of decisions. So with this, Gianni and colleagues and dear audience, I would like to conclude a few questions that are definitely going to be high on the agenda, because the pressure for tax authorities to collect more money is understood. And so a bit more clarification would be extremely helpful. So thanks again for giving me the opportunity. Back to you, Gianni.
Thank you, Isabel. Thank you for these comments about the risk allocation, especially also about the concept of the value creation. And as you mentioned, also an important role is played about the, this idea of working remotely. So that's why, as we know, a principal company needs to demonstrate economic substance, substantiated, of course, of the functions who actually are performed at the principal and the principal level as well. So, but in any case, we need to pay attention what also recently happened because of COVID-19, for sure. But in any case, the key point about the where the functions are located remains. So that's why now I would give the floor to Professor Marino to discuss the topic about the tax mobility under pandemic, the new thoughts for the old paradigm of nexus and their impact on the value creation. Please, Professor Marino.
Yeah, thank you very much, Gianni. I wonder whether I could show my...
You want to share the slides by yourself, or you prefer?
Yes, I can. Okay. Well, thank you very much for the invitation, and many congratulations for the previous speakers, who offered a very interesting perspective on the issue of profit split method. I would say that my contribution is in between what I heard from Paolo and Daniele, with the specific reference to the qualitative aspects into the determination of the profit split method determination, and the working remotely of Isabel Verlinde, and making reference also to corporate tax governance, because the tax mobility under pandemic is indeed going into both directions. It is helping the technicians to determine the real value depending on where the functions and the risks can be allocated. But as a matter of fact, it is also a matter of risks management for the corporation itself, not only because of the transfer pricing rules and the setting up of the transfer pricing, but also because of its allocation in terms of residence, in terms of presence of possible permanent establishments out of the country of residence, as well as all the responsibilities in terms of tax agents, withholding tax agents in light of all the managers and all the employees of the corporation itself. So it's a very complex approach. I would like to synthesize in a few words by saying, as a subtitle into my slides, that I am very much fascinated by the global ambitions about tax mobility under pandemic, and I make reference to the OECD approach that is very cute into saying to the member states to be very much wise into approaching the issue of connecting criteria during this, I would say, third world war, that is COVID-19. But as well, I am very much scared about the local hypocrisies. Global ambitions by the international organization, but local hypocrisies about single member states. So, and the mix is going to be something that we need to monitor in the future because of the determination of profit split and the risk assessment of corporations. Well, we all know, so I can just stay on my agenda. We all know that once COVID exploded, the OECD immediately, having probably knowing its member states, immediately reacted with a recommendation. The recommendation has to do with the guidelines that has been released the 3rd of April of 2020, whereby the OECD Secretariat said, dear guys, dear member states, let's wait and see, do not take any position about the different interpretation on the various residence of individuals at today because of lockdowns, and let's see what happens. So the idea is to have a wise application of treaties and domestic rules as far as the residence of individuals are concerned. And as a consequence, this is having an impact on various other arguments, because it's not only a matter of the residence of individuals that are in lockdown in a country when they work in another country, but it is as a consequence having an impact also on the corporate body in terms of possible permanent establishment presences where the individuals in lockdown are working from remote. So it is not a smart working, because if it were a smart working, I think it would have been so smart to cover also tax issues. But it is a remote working, and remote working is something different, as Isabel was saying. So because of the remote working, there's going to be the possibility to have a permanent establishment into a country. And the OECD said that we should avoid that danger because having a permanent establishment because of a presence of managers, employees in lockdown in a territory other than the territory where they were allocated could have an impact in terms of business income determined into that country. But I would say that in the backside, even if we accept the idea there's no permanent establishment because everybody is going to respect the OECD guidelines, there could be anyway another possibility to have a different approach on the transfer pricing, because nevertheless you have functions that are working from remote in a territory other than the territory that is shown within the country file and the master file, and as a matter of fact, this could bring an impact into a different determination on the transfer pricing methodology. And that is the first issue that was raised by the OECD. Watch out about the possibility to claim the presence of a permanent establishment where the employees are in lockdown because of their lockdown, so because of their remote working. But the issue is not only in terms of a permanent establishment, but it is also a, I would say, even a worse scenario that has to do with the concern of the residents of a corporation. Because if the employees or the managers are top managers and are binding decisions for the corporation at top level, well, there is a matter of visualizing into a territory other than the territory that has been always shown to authorities also through country by country reporting of the place of effective management and control. And we all know that the issue is, not only having an impact in terms of business income produced within the territory where the manager is remotely working, but of a worldwide taxation, worldwide business income taxation, because of the decision taken by those managers, or that manager is going to have into the daily life of the corporation. Certainly, this is a matter that is not, I do not see a great impact within large multinationals, but if we talk about the Italian multinationals that are, I would say, big companies, but just the top corporation represented by few people, that is going to be a problem. That could be a problem. So these are the two issues that the OECD is basically representing, as well as an issue having to do with the residence of the workers, specifically with the cross-border workers. So there are concerns about the status of individuals and because they are moving or they are not moving because of the lockdowns. And as a matter of fact, this has having an impact on the positions of the individuals and having a consequence into the position of the corporation in terms of withholding tax agents on the taxes that should be paid and should be withheld into the salaries of these individuals. So in conclusions, the OECD is basically recommending to keep very wise the position in considering and the extraordinary period of time we are all living because of the pandemic, and to wait and see. So to do as nothing is happening in terms of taxes, in terms of changing of status, because it is a domino effect. It's having a domino effect. So from individuals, we go at least to permanent establishment, at worst to residence of corporations, and last but not least, if nothing happens, in terms of transfer pricing, because that is probably the hidden effect of what I am describing. If this is a global ambition, I must also make reference to my concerns about the local hypocrisies, how member states are reacting before this global ambition of the OECD. Well, certainly everybody is saying, well, that's fine, the OECD is well representing in a single voice the entire club of the rich countries, and we cannot politically go against the OECD. It is an intergovernmental institution, and as a matter of fact, it would be very, very strange to go against the OECD. And this is the reason why, for example, if I just make reference to the Italian case, there has been a question mark before the parliament to the government with a reply on the matter, whereby the government has certainly replied saying, certainly no question about it, we are in favor of the OECD guidelines, and as far as the adoption of these guidelines, Italy will do its best in order to be compliant with the recommendations. At the same time, and by the way, I take the example of Italy, but I could certainly then spread the examples all over the world. At the same time, very, very recently with a ruling, a private ruling of number 345 of 2021, very few days ago, the Italian agency said something totally different from what has been said to the government within the parliament reply to the question time. And what the revenue said to a specific request which was made by a French multinational having an employee, a manager, who was a resident of Italy, but was exclusively working in France with a contract that it is treated from the Italian perspective very specifically within the income tax code, saying that you can be resident of Italy, but if you have a contract through which you perform your activities exclusively in another state, well, we are going to compute your taxable base in a more favorable way. This is a domestic rule beside the application of the treaty between Italy and France. By the way, about Italy and France, as well as Italy and Switzerland, about Italy and Austria, Italy has concluded some agreements on following the global ambition of the OECD very recently, saying as far as the cross-border workers are concerned, we certainly cover the issue requested by the OECD by saying that nothing is changing. Even if there is a lockdown, nothing changes in terms of determination of the residence of the cross-border worker and its determination of the taxable base, as far as the international tax treaties are concerned. Nevertheless, with this ruling, Italy overturned this interpretation by saying, well, this is a different story. You're not asking, because the request was made by the French multinational to the Italian revenue, saying, do you confirm that the treatment of this manager is exactly the same as before the pandemic? Because the guy never came in France, worked in it remotely from Italy as if he were in France, but he was physically present in Italy. And the Italian revenue clearly and honestly said, I'm sorry, I can't agree on that. It is true that we have concluded an agreement with France following the OECD guidelines, but at the same time, we are now discussing about a domestic tax provision. And in terms of domestic tax provision, I'm afraid that the remote working is a kind of work that we need to see where has been performed. If it has been performed from Italy, well, we cannot apply the favorable regime by excluding a larger portion of the income earned in France from the Italian taxable base. And that is quite a paradox and totally overturn in consideration of the international obligation. As a professor, I could say that certainly in terms of benefits, if an individual is remotely working from Italy because of the lockdown, and if he needs to go to the hospital, certainly is getting the benefit of the Italian hospital, not certainly the benefit of the French hospital. So as a matter of fact, there might be also the reasoning saying that he needs to contribute in the country where he is in lockdown. Nevertheless, that is another story, because the international engagements are going into another direction. But Italy is not alone. Italy is not alone. Is in good company. I should make an analysis on the various positions. Here you see that, for example, Canada, Ireland, UK, Australia, they are saying we are fully complying with the OECD models. Well, I would say, yes, I can understand why they say for us nothing is changed, because since they are importing a lot of managers from elsewhere, the idea that the managers are in lockdown and are remotely working in the places in the country of origins certainly is useless from their perspective. So I can understand the idea why they agree with the position of the OECD, because nothing is changing in their position in their revenue position. Another story is with the United States, because the United States have declared, as far as the permanent establishment is concerned, that and that has to do with the guideline of the Internal Revenue Service. They are fully complying with the OECD guidelines, saying that services and other activities performed by one or more persons temporarily present in the United States will not be taken into consideration to determine whether the non-resident or foreign company has a permanent establishment in the United States. I would assume that that position is closely related with the American philosophy to look at the place of constitution of a corporation, not really the place where a corporation is effectively managed and controlled. My idea goes back with the Apple case, where with the double Irish companies, a company that was set up in Ireland and effectively managed and controlled in the United States, being resident nowhere. And so I would understand in that perspective the position of the United States. But certainly closely to the Italian position is the position of Spain. Spain has been quite clear in saying, unfortunately, cannot agree with the OECD recommendations. So whatever we can claim, we can assess in terms of mobility or presence of managers into the Spanish territory as a consequence in terms of residence of individuals, as a matter of fact, as a consequence in terms of permanent establishments, or worst, residence of corporations, and transversally in terms of transfer pricing rules. There's last but not least, to have a sort of, mirroring effect of what is happening again in the United States. The United States said, as I anticipated to you before, that we do not see permanent establishment or place of effective management and control within this extraordinary period of time. Nevertheless, if you look within the United States, in the various states, they are fighting each other in order to understand where the managers should be located, because we all know that many managers went down in Florida to make their lockdown. And as a matter of fact, this is creating problems in order of tax residents in Florida, and as a matter of fact, also bringing other consequences. So there has been, there is indeed a tremendous domestic war in terms of mobility, interstate mobility, that is anyway giving some thoughts on the matter. To make a long story short, I would like to conclude my remarks by saying that I am quite skeptical that the OECD could really prevail into the intention to keep wise in the agencies away from asking for a price of lockdowns. And the idea that the arbitration clause within treaties is not entirely perfect in terms of application could again trigger to the opportunity that is a myopy, certainly, by the revenue to ask for money either in transfer pricing, either on permanent establishment, residents, and probably the last is income taxes on the managers, so on the individuals, because it is more certain to make some requests and then to see what happens into litigation in terms of application of treaties, because if you do not have an arbitration clause and you need an Italian, at least from the Italian side, a judge in order to have the right for the application of the OECD guidelines or the treaty or the agreement, you risk to waste a lot of time and money. So my conclusion is a recommendation in terms of corporate tax governance, going into the direction of Isabel to prevent these risks very carefully at the beginning. So because we will see the reactions in terms of 5 to year times, at least from the Italian perspective, while today we have all the conditions to prevent that kind of situation. Thank you very much, Gianni, for the invitation, and I give you the word.
Thank you, Professor Marino. Thank you for your contribution. Thank you, because we actually wanted to touch this topic as well, because we also saw how much it is related to the topic of today, to the main topic of today, because we are talking about function analysis as well within the principal model and the profit split method. And definitely because of the COVID, and definitely after the COVID, we have to cope with this kind of work remotely. Maybe we will pass from the work remotely to the smart working with a slight difference between the two, but definitely we need to cover also from tax perspective this aspect, which actually is more complicated definitely on the individual level, but we need also to pay attention on the corporate level, whether or not this creates permanent establishment on one side, and also if it is, if it undermines, let's say, the profit split method, if it is applied in a specific case, or the principal model itself. So we traditionally know that when we have the principal model, in this case, we need to have value creation at that level. We need to have the decision makers physically, present where the principal is. So, but now the environment is quite changing, and that's why we wanted to touch this topic as well within this webinar. Thank you very much, Professor Marino. And so we started talking about the case study proposed by the colleagues from Unilever about the profit split method within the principal model structure. And we went through the risk allocation, and then somehow through the functional analysis, looking, of course, and the mobility of the functions of the managers. And now we go with the other two further contributions, both from multinationals, just to have an overview what actually is happening from other multinational sites. And then I give the floor to Massimo Ferrari, the head of tax from Pirelli, and the contribution from him will be about, does the right TP methodology actually exist, with question mark, the perspective of a multinational group. Please, Massimo, the floor is yours. Thank you.
Well, thank you very much, Gianni, first of all, for inviting me to this very interesting and valuable seminar. So much appreciated. Well, I have listened with much attention to my colleague, to the speakers that have spoken so far. And I have to say that they, as correctly was pointed out by Daniele and Paolo, there is a lot of food for thoughts, I have to say. I could even skip my speech and just commenting what others have said, because there is really a lot. I just pick up 2 or 3 highlights from their speech. First of all, starting with Unilever. Of course, the message is very clear. So, depending on which methodology you decide to apply, let me say that Paolo and Daniele made it extremely clear in the way in which you switch profit. And the example that Daniele and Paolo made is very simple, very academic, but it's very impressive. So if you move from a limited risk distributor approach to a profit split, here we are. You are moving completely amounts in the profit and loss between one jurisdiction and the other, and this must be carefully noted. Then, if I move to Isabel, Isabel ended her speech saying, you know what? There will be pressure for tax authority to collect money. As simple as that. As simple as that. And so I start from two different approach brings money in different countries in a very, very materially different way. Then Isabel is saying, be careful, because at the moment there is even more than in the past a huge pressure need to collect money because we are in a crisis. We are in pandemia, and so be careful. And then I come back and conclude with Professor Marino, which honestly, the message from professors is far from being reassuring, even the third one, because I totally agree with him that we are looking at a global ambition. We are looking at OECD approach, which is absolutely appreciated. It's fair. And it's a message that is given to the government, to the tax authority. Please be careful. This is a mess. This is a period of high uncertainty. People are locked down, seriously. The guy probably working for the French corporation was not here on a beach, or was not here for holiday. He was locked down. He couldn't cross the border. So be very careful. Be very careful. Look and wait and see. And the local approach. I would say local approach. I would not use Professor Marino word. So a little bit lighter. Local approach versus global ambition. And Professor Marino quite interestingly pointed out a few countries taking an approach which is materially different from what, let me say, the OECD is stating. And this is extremely worrying. It's extremely worrying if you put all together. Now, again, and closing on some comments on what I have heard, Professor Marino concluded his speech saying, I am skeptical that the OECD will prevail in delivering his message into each single countries. And we have touched Spain, Italy. I was not aware of it. Thank you, Professor Marino, the very recent ruling, but then Spain and then US, and then each single state in the US taking a different approach. So very, very difficult time, time of uncertainty with government desperate for money. Here is where we are. So if I may spend just a few minutes on the so what. So what is the approach of a multinational? What a multinational group should do to protect the group and to try to minimize the risk, the impact of doing business in this environment. Well, let me say that my perspective is, my personal view is not Pirelli's view or what Pirelli is doing. It's my personal view, and I have to say also shared with a good number of friends doing my same job and work. So let me say that for me, or let's say my overarching target is just one, which is minimize the risk of double taxation. If I am dealing with transfer pricing, principal model, profit split model, other model, which one is the right one? And probably does not exist the right one. If we want to say in a simple word, there might be one which is more appropriate than the other, but depend on the viewpoint, because the tax authority may totally disagree, right? And that is something that we are facing every single day. And if the target is to minimize, ideally exclude, but this is a mission impossible, the risk for double taxation. I think the multinational group probably has some tool to try and minimize this risk. And let's say, let's start from the functional and risk analysis. And I have to say, Paolo let's say Daniele went through it very, very well. But let me say, a functional and risk analysis must be, in my view, first of all, solid and robust. What does it mean, solid and robust? It means that it's not for myself to do it. Absolutely not. It is for myself, probably, to coordinate it. But it must go through the involvement of each and all the relevant stakeholder in the value chain. Of course, the tax director, in theory, knows very well the business of the company for who pays him or her. But still, you need to go through interviews, you need to understand, you need to really speak with people who are doing business. Tax director, generally speaking, does not do business, does other things. And once you have done it, you absolutely must document it and make it auditable. Because it's not for you, it's not for the tax director, the CFO, or the company. There are other stakeholders who are going to come sooner or later, who are tax authority and not just tax authority. And I have to say, on top of that, I have in my mind one absolutely fundamental element is consistency. You can't choose, you can't think that one methodology is most appropriate, is most, let's say, adequate for your business. Fine, that is a choice with some element which are absolutely, by definition, judgmental in any multinational, in any corporation on earth. But then you need to be consistent. So depending on the complexity of your business, you need to pick up 1, 2, 3, possibly not very many key players. Who are the key players in the value chain? The limited risk distributor, just to quote the example of Unilever, or the contract manufacturer, or the service provider, or the IP owner, and they would stop there. Then you might have the contract manufacturer or the toll manufacturer. You can have a limited risk distributor with a warehouse or without a warehouse, and so on and so forth. But you should absolutely not, let's say, multiply the number of key players. And then you do the functional analysis, the risk analysis, and you try to allocate the right profit. I have to say that another element that in my experience is vital, absolutely vital, is simplicity. You must keep it simple. Tax authorities, rightly, I would say, are reluctant to accept over complex models. This is my personal experience. Keep it simple, please. It's not an academic exercise. It's a model which must run and must run appropriately in a multinational, must be, let's say, understood by tax authorities, must be, let's say, rightly implemented, and must be consistent and simple. A fantastic, let's say, academic transfer pricing model, which no one can understand, is the perfect recipe for failure. Then coming back to one point that was mentioned in the previous speech, whether it is or is it advisable or even possible to have different transfer pricing model, I would say within the same corporation, within the same country, or even within the same legal entity in one country. And that is, of course, let's say, very judgmental. Maybe I have a view and Gianni has another one and Daniele another one. So there is not right and or wrong. My personal view is that yes, it is possible. It is possible as far as it reflects the value chain proposition and the channels, the activity, are clearly segregated. I cannot say in principle a veto or a drawback in having one or two different model, profit split or limited risk manufacturer or distributor, if these fairly reflect the reality, so the value chain. And then what is extremely important is compliance. You choose it, you decide to have more than one model, you must execute it properly. Then let me say, in terms of consistency, and looking at what we are dealing with in this seminar, you must be consistent always. And when I say always, I mean also during extraordinary years, during the pandemic, during 2020. Hopefully 2021 will be better. Still in a mess, but let's say we can see the light at the end of the tunnel. So consistency also here, if you want to have a defensible proposition towards whichever tax authority, whether it's Russia, China, or Brazil, I don't care. This is of fundamental importance. Let me try to make a very simple example. Linking to Daniele's presentation, I am a limited risk distributor. And applying OECD guideline, comparable, all these, I get 2.5% return on sales. Perfectly in the range, and everything is perfect. Now I am academic. Well, fantastic. There is a pandemic, and my principal, who maybe earns, I don't know, 10 times what I am earning, or 8 times, or 6 times, or whatever, come to me and say, sorry, guy, there is a pandemic. You should share, let me say, part of the loss. So 2.5%, no, it's not good any longer. You get 1, 0, or -1, -2, -10. Let me say that is right or wrong, I don't know. But let me say that I must be consistent. Because if what I'm saying is not that the limited risk distributor should not be affected by the pandemic. This is not what I'm saying. I'm saying that not necessarily must take part or must not take part, depending on a case-by-case analysis. But let me say that if in the last 5 years I have earned 2.5 and the principal has earned 25, it's a bit difficult, in my view, to say now you earn minus 2.5%. Because if I am a limited risk distributor, I would say next year, 2022, 2023, say, sorry guys, I am the guy you ask to share the loss. Now 2.5 is too little. Maybe it's 4, maybe it's 7, because now the business is up and running again. So let's say that depending on the single case, and one thing is reduced aggregated profit, the other one is a loss. So if it is a reduced aggregated profit, but still a profit, maybe the 2.5 might go to 2 within the range, etc. If it's a huge loss, then need to be carefully examined. Aggregated, I mean, because if then the principal makes money, it's a little bit difficult. Now, again, coming to the conclusion, I would say consistency also in aspect which might look minor, and Paolo and Daniele made it very clear. So whenever you speak of relevant accounting standard, whether the way in which you choose the currency, the decision of looking at actual data or budget data, all absolutely consistent. You must make your model consistent, because the more it's consistent, the better you will defend in case of challenge. Now, my experience is that if this is the case, if you are good enough to have a very strong model, you will definitely get a challenge. Absolutely, definitely, because this is a part of the game. right? And not necessarily the decision of the corporation is the right one. But probably it's a little bit more difficult, the challenge, and we might go into a different area where it's more or it's easier to challenge. So the range. Okay, the model is fine. This is the range. You choose the median, but for me, the median is not 4, it's 2.5, and I challenge on actually the comparable and so on and so forth, which happens, well, in my experience, very often, if not always. But it's a different kind of challenge. It's not putting under the discussion the model. It's putting under discussion the rate. Now, I have to say that this is not the only way of navigating this difficult water. I mean, because the international tax system offers method to go further into the let's say the protection scheme, into the trying to achieve the target of avoiding double taxation. How? Well, you know better than me. There are APA, there are BAPA, which is even better, and since I would say, can I say 4 years, but still in a pilot phase, ICAP. Well, in that case, you try and get the tax authority to speak one to the other, and not the tax authority speaking just with me. Then, of course, you always have an MAP. MAP is, as you know better than me, is ex post. It's not ex ante, which is a completely different world. Now, so lots of challenges. Absolutely yes. Some way of protecting, yes, absolutely yes. Difficult to find the right compromise. Is it possible to take out the risk? Not at all. There is no way on earth that you arrive to a zero risk approach, but this is a possible approach that multinational can take. But let me conclude, Gianni, by saying that well, very interesting to listen to functional analysis, risk analysis, OECD guideline. OECD is doing a fantastic job, and so on and so forth. And then Professor Marino rightly pointed out the principle, which in my view does not make any sense today, of effective place of management, or place of effective management, to be more precise. What does it mean? What does it mean in 2021, where people are locked down here, but maybe they stay longer than that? And where is the company effectively managed? I don't know. I don't know, honestly. And where is this webinar taking place? In Rome, in Milan, or where Isabel is, I don't know, Belgium or wherever. Where is it? And this is the way in which board of director meetings are taking place. Not only shareholder meetings are taking place. So what does it mean? What does it mean, honestly? So this is the reason why I like to conclude saying, well, is the topic we are debating today already out of date? Food for thoughts. If, Gianni, you invite me, hopefully, in a couple of years or in 3 years, and will the debate be completely different? Because we are now, today, the 30th of June, debating, let's say, what is written in Joe Biden's The Made in America tax plan that everyone, I think, in this room has written, publishing yesterday, April 2021. So really a couple of months ago. The G7 focus on what? Global minimum tax, or source countries, market premium, and so on. This is a completely different world, which is coming. I don't know when it's going to come, but definitely there have been progresses in the last few months which deliver the message that something is dramatically going to change. And all what we are discussing today, which is the real life, because tomorrow morning I get an assessment and I need to prove that my TP are right, according to OECD guidelines and so on, might really change in due course. So again, this, and then I conclude, this just to add another element, which I think, in my view, it's interesting for debate. The world is really changing, but not just for the COVID, and not just for the OECD setting some principle or clarification, but really the pillar of the international taxation, let's say, rules are under discussion at the moment. So who knows what is going to happen in the forthcoming 2 or 3 years. So I stop here because I'm very conscious of timing. So thank you very much, Gianni, for giving me the opportunity to share some thoughts with you.
Thank you, Massimo, for all these feedbacks. I would really like to touch 2, 3 of those points. I will start from the last one. Yeah, the world order, the question mark is the world order is already changed or is changing. So definitely there is some friction between how is the business model now, which kind of international tax rules we have to apply now. As I said before, we traditionally we have this traditional idea based on the traditional principal model to allocate the decision makers where they are physically located. So we try to bring functions, to bring people where the principle is in order to substantiate the principal structure itself. And now maybe it's changing. Definitely there is an acceleration due to the COVID-19. We can definitely cope with this extraordinary event due to the COVID-19, but maybe this event is becoming more ordinary than extraordinary over the next few years. So we definitely needed to cope with that. That's the first comment. The second one is about the key word of your contribution is consistency. I'm definitely a fan of the consistency about the TP structure. For a couple of points, or for a couple of reasons at least. I'm definitely a fan of the consistency, whereas possible, of course, in the ordinary situation, so no COVID at all, so in the ordinary business model, because this helps even to provide argumentation and explanation if you get a tax assessment at the local level, because, you know, more consistent is the TP structure, more solid and more stronger you are to explain to the specific local authorities which is the model you apply, why you left, for instance, the fixed or the stable remuneration at the local level in that country, as well as all other countries, because we have a solid principal structure at the central level. But also in the extraordinary event like the COVID-19, as you correctly said, we discussed this, I think, in the first workshop we organized, because we have to pay attention also in the allocation of hazard risk, of all other issues risen by the COVID-19. So, because in some cases was also told at the time, I said that we can run otherwise the risk to be assessed, like if there is an extraordinary event, if you change something with respect to the past, you can maybe get assessment of a business restructuring actually made overnight because of the COVID-19. So there is also this kind of topic to discuss. So about the consistency itself, but the key question of this webinar, I go back to the key question, is about the profit split method. I know that somebody says that the profit split method is definitely applicable for the principal structure in theory, not in practice. That's what actually I heard or even read from somebody about that. But as you said before, if the tax department follows the business how it should normally work, if we involve all the value chain, if we involve all the other business stakeholders, all other stakeholders in the analysis, maybe there is a room to apply the profit split method if we are definitely consistently, and I use the same word, consistently with the value chain itself. So just 2-3 comments after all your contribution and your last.
Thank you for that, Gianni. Yeah.
Thank you. I would then go to the last contribution now, and we go back to the matter of the mobility of the people and the tax mobility and the pandemic, how it was dealt with and addressed by the multinational. In this case, I give the floor to Paolo Biaggi, who actually is the head of tax of the Engie. Please, Paolo.
So let's come back to the issue of the mobility. As Professor Marino said, let's say OECD gives some, let's say, I can say advice, that is a guidelines, I say advice, but local authority don't follow very well these advices. We're talking about mobility contracts, so we're talking about assignment that are more of 6 months, less of 3 years for Engie, and assignments in the benefit of the host entity. How we work in Engie is that we make expatriation contracts where we can, meaning that we make a contract where the employee is no longer is employer of the home entity, so of the host entity, meaning the company that is in the country. And where it's not possible, we make a secondment agreement where the employee is still an employee of the home entity, and there is a secondment, so a service contract with the host entity. The other way in which we make international mobility is the commuting. We have some person that are employee of a company in one country and goes for some days somewhere else in another country. For example, the CFO of the company in Greece is an Italian resident, and he goes from Rome to Athens every 1, 2, 3 days a week. What happens during the pandemic? We have some cases. We have cases where expats come back to the country of origin and they doesn't come back to the country for which they are working. Here, nevertheless, the OECD papers, in Italy and France, there was 2 resolutions, and individuals will be taxed, has been taxed in their own country based on the position of the local authorities, meaning that, for example, we have France CFO that in 2020 passed less than 183 days in Italy, even if she worked for Italy all the days, and she was taxed for her individual taxation in France. Because like Italy, even France say if you don't stay 183 days in another country, you are taxed based the country of origin. Then there are workers that have been temporarily in other country because they couldn't come back, but in this case we have no consequence because in any case we have people that stay outside more than 183 days. We have people that move from Italy because at the beginning of the pandemic, Italy was one of the countries that was more affected. So people decide to go to Switzerland or to other countries. And even in this case, we have no consequence because they remain in these countries less than 183 days. One other issue that we have, but it's not linked, it gives not big issues from a tax point of view, but was only internal issues because I have colleagues that cannot go on with their career. They are blocked because, for example, they finished their assignment of 3 years, but they cannot make application to new position because it was said to them that they cannot do any application unless there is not a possibility to move in other country. For example, people, we are going out from China. People in China currently are there and they cannot go away from there since a period that they have to pass there. So they cannot grow, they cannot move in their career. We start internally to speak a lot about what will be the new normality. The international remote working can be divided into parts: international flexible working and filter assignment. International flexible working, what it is, it's or work from anywhere, meaning a person goes anywhere and work for an entity that is in another country, or digital nomad. The digital nomad, what is, it's a person that we stay 4 months in one country, other 4 months in another country, and all is working for the same entity. I saw that some countries like Croatia or Mauritius already made some legislation to allow the digital nomad to stay in their country for a longer period than the one foreseen by the travel in that country for tourism. And this is the international flexible working. Then there is the virtual assignments, where people remain in their country, where their own country, but have assignment outside of the country where they live. This is the two way of international remote working, which we discussed in the last year, in the last period. So what has happened? That many CFO have communicated at the beginning that the world will change. The office will be changed. The layout of the office will be changed. Even here, even as we are making a lot of discussion about the new layout when we will come back to the offices. In time, 10 years ago, all the people have an office. Now, let's say that all the people are in open space. For example, the group tax director of Engie is in an open space, doesn't have an office. What we are doing, we are even thinking to new layout of the office. We have to change everything, because what the biggest issue that we have today to go to work is that we need offices that are closed to make our meetings. Another point that is happening is that during the job interviews, all candidates normally ask what will be the new normality, if they can work from home, if they can work from abroad, from where they can go to work. Currently, many entities are reviewing their position. Google, Apple now are saying that at least 3 days all the people must go to work. And as far as we know, only Spotify has implemented the work from everywhere. Spotify is, let's say, we know very well Spotify because it's the case that normally managers and other employees are telling us, look, Spotify is doing, has implemented work from everywhere, and all will go in this direction. What is Engie approach? Let's say that based on what even Mr. Marino has said, Professor Marino has said, let's say that we don't have a clear view of what will happen. Engie is divided in views. Some views are global. And let's say that this new way of working from everywhere for any company was seen as a way to have much success, to have employees that are more happy to work. But let's say at a certain point, Edge approach became the location of employee must be the location of the contract entity, meaning the company that pays for the salary, and the location of booking entity, meaning the location of the country where taxes are paid. So this is the principle that we are following and we will follow for the future. Sorry. Engie with other French entities make a work group and start to discuss all together what will be the future and how this company want to implement the new setup for the future. As already said, the situation linked to COVID-19 is covered by the OECD, even if not all the countries are following these advices. But we can say that OECD works for the future are not in place. Nobody knows what will happen at the end of COVID-19, or better, what we know is that at the end of COVID-19, everything comes back as before. So all the rules already explained by Professor Marino will come back. So the link between the residence of a person and the taxable the taxation will be very strictly linked. What are the risks that we see? Not apart the one of taxation that we already seen, like transfer pricing and permanent establishment, there are some risks from a human resources perspective, because not only for the company, but even for individual, because the individual where will be taxed where he works or in home country. And another issue that we saw is the compliance, because there is some kind of activity that we performed that are under regulation or markets. For example, we have traders that are under control or some financial institution, and there the rules of people where they are for the production of P&L are more strict, very, very strict. So what will be the probable approach of the future? And another point is that the administrative burden that we will have to face in case of work everyone from anywhere will be very, very important and risky. We will not, we are not open to virtual assignment, meaning to people that will work from a country to another country, and on working from abroad will be not allowed. One thing that we make, because after some discussion, we have other internal discussion to see if we can open more position for the people. Employees has been divided in two categories. One is the one that generates P&L, meaning employees concluding contracts or having key intermediary function or managing directors. These people that can move P&L, for them is not allowed in any case to work from abroad. While for people that are not a P&L generator, like stand function, like a tax manager, for example, will be able to work from abroad, but for a very limited number of days a year, not to create any issue of PE or any other issue. What have been asked to HR and to tax manager is to follow what will be the evolution, the OECD evolution, the evolution of the countries, because there is a willing from one side of the entities to move to a solution that is more, there can be more welfare for the people. But on the other side, we have to pay a lot of attention to all the risks that we can have, because the world is still not, let's say, open or ready to this, to modify the way of working, and the rules are completely based on the physical presence of people in the country. And until a big and a huge change in the legislation will come, will be difficult to set up something that will go to an international remote working.
Thank you, Paolo, for this overview also from multinational about the work remotely. And yeah, I would invite, if there is any other comments from the other speakers, I would invite you, of course, to feel free to do any comments about all the other contributions. Daniele or Isabel, if you have another comments, please feel free, like Professor Marino Ferrari. Otherwise, I give you the floor. Daniele, you have further comments since the case study was proposed by Unilever. If you have further comments, please feel free.
Yeah, no, just to confirm that we have clear challenging also regarding these people location. And I don't know your experience, and I understand that you are facing the same the same problems across the world and for the multinational. Especially during this pandemic period, we have a moving of people from country to countries, people that come to the home country from the host countries. And these moving of people are generating also challenging and the request of proof substance in some countries. So moving people 99% of the time means to move substance, because at the end of the day, okay, the asset, okay, where the legal headquarters is located and so on. But at the end of the day, people are the main substance also for the multinational. So moving people means move substance. And just this is only to confirm that tax authorities, especially during APA or bilateral agreement, they ask, first request is just the organization chart where with the location indication where the people are, in which legal entity, and in which nation, in which legislation are taxed. Also to understand where they are located. Just to adding another pieces, many times now we assist to, as we commented, to smart working or home working and so on. So which is really important now. The first request, first time that we also assist to this kind of request, tax authorities start to request the tax residence of the people, the home address of the people, also challenging the problem of privacy and so on, because before we say, okay, these people are located in Rotterdam in our headquarters, these people is located in the Rome office and so on. Now we assist to first request where they ask home address of people, because they know the effect of the pandemic and the home location. But it's important also to have people in the right, not only in the right place in terms of company, in terms of legal entity, but we need to start to think about the right place in terms of taxable country. So that's my experience that I'd like to share with you on this topic.
Yeah, that's an issue, because there are, as far as I see so far, there are people that you know, due to the COVID-19, their tax residence was qualified differently, because if they were locked in one country and not in the country where they normally work, so the first country actually qualified their tax residence over there. So this would be already an issue on the individual level and the corporate level, of course, accordingly. Isabel, any comment from your side?
Thanks for giving me the floor. Yeah, very interesting observations from all the speakers. And I would like to maybe add something to what Massimo said in particular on the keep it simple, and also picking on a few things that have been said before, like countries need more money. My point is on how are we going to deal with this? And when I'm looking at the participants and the other speakers, I think most of us are based in the EU. There are so many transparency initiatives ongoing, and what I would like to add to that is there is not that much possibility to get upfront clarity on these matters, like on mobile workforces. And so we have the Directive on Administrative Cooperation that started in 2016. We have, okay, we understood that exchange of rulings and CBCR. Then we had DAC 6, and sometimes my eyebrows were lifted by what the hell do we need to report under DAC 6, because this is a genuine business transaction. Now we have DAC 7 with a tremendous opportunity to move towards meaningful transparency, and I'm wondering whether it isn't time maybe for academics to write on this matter and on this mobile workforce. I heard residency issues, PE issues, but when I saw Professor Marino, what you mentioned about that state tax case in the US with Massachusetts, I almost fell off my chair. But this is something that might also be a source of inspiration for European countries. And then I think that it's about time to use the directives on administrative cooperation in a meaningful way to address these sorts of matters. That would be an observation I had, Gianni. Thank you.
May I ask you about your idea on the concept of consistency, since it was a key point from Massimo Ferrari as well, the consistency about the TP structure in the ordinary situation or even in the extraordinary situation like COVID-19. You wanted to comment, would you mind to comment as well on that, Isabel?
Well, the only comment I wanted to make if on that one, Gianni, is I'm confronted with so many clients who are subliminally finding themselves in a situation where you may be doing something that creates a lot of trouble, whereas the only thing you wanted to do is be coherent, consistent, and clear about your transfer pricing methodology. And you find yourself in a completely different situation. So that was what I thought, taking as a starting point, like these ocean freight crises and so on. You have to move in your supply chain. I take the ESG agenda. Everybody talks about that. This is about end-to-end sustainability, not only to whom you're selling, but from whom you're buying. Transparency will take an important stake in it. We're talking a lot about governance. We're talking a lot about environmental, but this S thing, like with public CBCR, it's going to give a lot of inspiration to tax authorities how you deal with the S piece of it, and also to the outside world. So that's why I addressed it. I think there are a number of means to try to get this sort of cooperation up front. We have a multilateral instrument that was only signed by how many countries was it now? 27 eventually, but just such a limited chunk compared to to what it should have been. So that was, I think, the direction of my somewhat critical remark here, Gianni.
Thank you very much, Isabel. Any other comments?
Well, I can take a comment by taking the chance of what Isabel just said about the Massachusetts case. So to translate the Massachusetts case within the European Union, because what I did not cover within my speech is the European position. Global ambition within the OECD and local hypocrisies or approaches, as Massimo Ferrari was saying, within the member states. But there is certainly a guest that is missing, that is the European Union. It is not unusual that the European Union did not follow the OECD guidelines recommending to member states to keep quiet as far as taxation is concerned. And we all know that in Europe, taxation needs a crisis to make a step forwards. So unfortunately, again, I see that cases in terms of tax residence will be then taken up to the European Court of Justice in order to be compliant with the general rules how the European Union dealt or is dealing with the pandemic, and so covering the European principles, but there's no chance that it will be the single member state absorbing and looking further into the application of the principles without making a shorter term request of revenue to the single manager, to the single corporation, but looking, unfortunately, lacking of responsibility and asking for a superior judge to say something contrary. That is unfortunately my personal view, which has a positive effect that we will make a step forward, but with a lot of, patience and resilience, as the case is of how we are managing the pandemic nowadays.
Thank you, Professor Marino. So thank you to all of you. I think this was this is actually the last webinar of this first cycle of webinars in pre-summer time. And I give the floor to the other co-director of the IBTC, Professor Marco Fazzini, for the conclusion.
Thank you, Gianni. Well, I think that the conclusion have already been done. And I thank you again, all the participants, to our webinars. And now, as Gianni said, we have a summer break for a couple of months, and we will be back on September. So we are going to organize new webinars, and we are going to go deeply in different topics about taxation and business, the core arguments of our center. So thank you to everybody for the participation and for the support they gave the center. And see you after summertime, and thank you again. Bye.
Thank you very much.
Thank you. Bye-bye. Bye-bye.
Bye. Thank you.
Thank you.
Thank you. Bye.
Bye.